Okay, without further ado, we have a really kind of special treat today. We've got Shane Williamson here, all the way from Denver, Colorado, where it does get 90 degrees plus during the summer, despite them being surrounded by mountains. Shane is a guy that I have known since 8th grade. He's kind of this guy that I've grown up with. He's part of my tribe. You know, you have these people that you have your actual family, right? And you have friends, acquaintances, but then you have people that are not family, but they're like family in that you just did so much life with them, right? We went to college together. Our careers kind of took different directions, but we've been friends throughout this whole time. It was actually a funny story. Our senior year of high school, Shane was a very entrepreneurial guy. Always starting businesses, always finding a way to make money, even in high school. And he started a curb painting business. And I was working for him in his curb painting business in high school because I was getting paid more than I was making at my job where I was making pizzas at Hideaway Pizza. And so was working with Shane, and he was paying us pretty well. I think he was paying us like $12 an hour, which was like an insane rate, in 2007, 2008. And then I went up and I stole his idea. I took his idea, I ran with it and did it myself. And it caused some drama. It actually caused Shane to begin requiring his employees to sign a non-compete agreement. we didn't even have like a real business for. And so all that to say is Shane is now a CPA. He started his career at a really prestigious public accounting company called Ernst & Young. And they do audits and tax work for the world's biggest companies. Then he learned how to develop software and went into like the development space for a number of years. And over the years, I would see Shane, and he had this idea of starting a tax and accounting business. And he had these new insights to the way that he would do the business with a software background, with just his business savviness. And I always really encouraged him to do it. And then a few years ago, he finally did it and is working with dozens of clients across the country. He's working with a number of Redmond growth clients as well. And I wanted to bring him in here today just because hopefully you guys have noticed, like what we did even with Lance Odell at the end of April. We did a workshop with him. We did the workshop yesterday, which was a little bit smaller scale, but still really good. We're bringing Shane in. At Redmond Growth, we really want to continue to make this a better experience by bringing in experts in different fields to help you guys answer the questions that you would like answered, but also to give you insights on things that we really believe that you should know. And so what we're going to do today is I'm going to turn it over to Shane here in a minute. And Shane is going to cover, I don't know exactly how you'd like to word this, but it's basically three really key, like low-hanging fruit opportunities for contractors. Tax savings opportunities, opportunities to save more money, maybe in your accounting, maybe the way you do your bookkeeping. But basically, he wants to provide three insights that was going to benefit everyone here. And then I might ask him some clarifying questions, but then I want to turn it over to you guys and any questions that you would want to ask a CPA, someone who works with a lot of construction companies, about tax, about accounting, about cash flow, about anything related to really business finance. Shane's your guy. And so, Shane, without further ado, would love to turn it over to you, my friend.
Thank you, Robert. Thanks for having me here. Rick, shout out. You're the only name I recognize, but Rick Johnson, who at least was on the call a minute ago, if you didn't drop, is a client of ours. Yeah, so I think what I want to do today is just kind of walk through like three things that some may seem kind of basic, but you'd be surprised. At least maybe I only get the bad cases, and maybe you guys have all your ducks in a row. But three of kind of the basic things that I think in order that every contractor and really every small business owner should do. So those three things are basically going to be hire a good accountant, structure your business the right way, and then after you've done those two things, then hire a tax advisor to help you really minimize taxes proactively. And then we'll get into just a handful of the things kind of along the way that I think can actually help. You know, what is a good accountant? Why are they important? What is a tax advisor actually going to do? And what are some of the things that we would do or that I recommend you guys do to save some money on tax that are pretty easy to understand and pretty easy to do. Okay, so first and foremost, hire a good accountant. I don't want to spend a ton of time here. I think Redmond Growth harps on this a good bit, but really, you know, having a good accountant is just like the foundation of knowing your numbers and knowing how your business is doing. You know, I can't tell you how many calls I have, especially like sales calls before clients really come on board, where people, you know, I'll say, how much money are you making? And I mean, when I say how much money are you making, you know, I'm asking basically what's your net profit? And the number of people that will tell me their gross revenue number proudly, you know, well, I'm doing $60,000 a month. Okay, well, that's good money. And then you dig a little deeper and you realize, oh, well, you're doing $60,000 a month in revenue, and you don't even really understand the difference between revenue and profit, and you're actually not making any money. In fact, you might be losing money once we account for everything. So, you know, just having a good accountant, specifically, you know, if you guys were going to go out and hire a new accountant or a new bookkeeper, the two number one things, you know, maybe three number one things that I would say you should look for is they should be using an accounting system. If you don't have any access to it, like it's not like QuickBooks Online or something like that where you can log in yourself, that's a little bit of a red flag in my mind. Number two is they got to be doing your bank reconciliations. If they're not asking for your bank statements, then they're not doing your bank reconciliations. And that basically gives you no guarantee that what they're doing actually ties out to reality. So just a couple things to kind of look for. And then really the third thing is, you know, not every accountant is going to do what we do, where they meet with you every month to go over your financials and make sure you really understand them in depth. And I understand that there's different business models out there, but at a minimum, you know, they should be sending you your financials at least once a month so that you get them. If you've got an accountant, but you never look at your numbers, then, you know, they're not really doing their job and you're not getting that full benefit. And, you know, when I say know your numbers, you know, just like a good example business expense decision that you can't really make without a good accountant might be something like, you know, honestly, something we ran into earlier this year is through some coaching from Robert, we were doing a little better on marketing, and we literally had too many customers coming in too fast right in the middle of our busy season, you know, during tax season. And so we had a couple different ways in which we were doing marketing. And I needed to basically cut marketing a little bit to slow down the pipeline so that I could make sure that I could, you know, deliver on all of our promises to our existing clients. But it's like, without a good accounting base, how do you even know which is your, you know, kind of worst performer in terms of marketing that you might want to cut? How would you know what these key metrics are, like, you know, your ROAS and return on ad spend and things like that? It's all accounting. It's keeping track of those numbers. By the way, I should have said at the beginning, if you guys have questions along the way, this can totally be conversational. I would prefer not to talk for the whole time.
I'm glad you said that, Shane, because this is, you know, when I was meeting with Shane and kind of preparing him for what a Redmond Growth Group call is, that's the context that I tried to paint it in was, hey, if you guys, just like really anything we do is even this way at the workshop, it's like we'll have a time for questions and answers, but if you got something that comes up based upon what Shane is sharing right now or clarifying question, please don't hesitate. Pop your hand up or unmute your mic. And okay, we already got one. There he is. Joey, we got a winner.
I've been waiting for this all week.
Okay, good.
Because as Bryce knows, we are having huge issues with with accounting and taxes and everything right now. And I just have a quick question, and it may not be quick. On the first one there, Robert, that you pinned on there that says structure your business the right way. What is the correct way?
Robert, did you tell him to say this? Because I had just wrapped up point 1, which was hire a good accountant, and I was just about to go there. So what a
Yeah,
segue.
I've been texting him this whole time.
All right.
No, I'm just kidding. I'm just kidding. No, that's it. Yeah,
Okay.
yeah. I think Shane's about to jump into
sorry
that right now.
I'm sorry if I got ahead, but I saw that pop up there, and I'm like, yeah, I
Yeah.
don't think that I'm
Just-
structured that way.
Yeah.
I'm just excited. So yeah, let's talk about it.
Yeah, let's get into it. So I'm going to jump to the solution first, rather than beating around the bush too much, and say that for, I don't know, it's got to be at least 90% of small business owners, and certainly contractors, and certainly, especially service businesses, really the right structure, the right tax structure is going to be for you to file your taxes as an S corporation. And I'm going to tell you why. Fundamentally, the reason is that you'll save a potentially, pretty significant amount on, not even on income taxes, which income taxes are the taxes that everybody talks about a lot, but actually where the savings is on employment taxes. And so, employment taxes, if you're not familiar, are your Social Security and Medicare, basically. And the way it's kind of set up to work, in most cases, is the employer pays half and the employee pays half. But the IRS does this kind of, sneaky thing, and on some level it makes sense, which is that if you're self-employed, so if you're just running a business, yourself, then the IRS kind of says, well, you're both the employer and the employee, so you got to pay both halves. So essentially what you're really looking at is like 15%, over 15% of these employment taxes if you're just an LLC that isn't taxed as an S corporation. And so that's really the main benefit of switching to an S corp. Now, it doesn't eliminate that tax completely, and it comes with some caveats, some extra overhead. But once you get to a certain size where you're doing enough in profit, and taxable income is really the right figure to focus on, then moving to an S corp is almost always going to help you, and sometimes pretty significantly. Looks like we got a question from Anthony.
Yeah, Anthony, and I've got a clarifying question on this point too, Shane. So Anthony, what's up, buddy?
Yeah, so you had mentioned of a certain size, and that's been my CPA has been, essentially saying, S corp's got some benefits, and it's not exactly the CPA that I can sit down with. He's like an end of year tax CPA, not so much an advisory one. So essentially the question is what is that size? Because it just hardly seems worth it to me. How can I know how much money I'm costing or how much money I'm saving moving to an S corp, or if I'm saving anything? Or is there like a, 6-figure, I don't know, 150,000 is the number? Is there a number which it makes sense?
Yeah.
What am I
No,
looking
great question. Literally the next bullet point in my outline. You guys are teeing me up just great. Keep it up. I use 100K in profit, so like net profit after all your expenses. Again, really what we're talking about is taxable income after deductions, but generally speaking, for most businesses, there's not a huge difference between your sort of net profit on your P&L and your taxable income on your tax return. If you've got a ton of equipment purchases that are driving big differences there, then that might be something we'd want to dive into a little bit before we make that S election. But generally speaking, yeah, around 100K in profit is what I like to use. And the reason for that, I've obviously run the numbers on this many times over, and you'll talk to, different accountants will use different figures. I've seen accountants or CPAs or whatever say you should move to an S corp as early as 60,000 in net profit. I think that's too early, and the reason for that is really just that there's quite a bit of overhead that comes with the S corp structure. Specifically, you got to have super squeaky clean books, because unlike just reporting basically a P&L to the IRS, once you go to the S Corp, you've got to report a full like balance sheet. And so you've got to have real kind of more formal accounting. Now, if you've already got an accountant, as I mentioned, you already should have an accountant, then that becomes sort of a non-issue, right? Then the next thing is, when you move to an S Corp, you have to pay yourself as an employee of the company if you're working in the business. And so that's like another thing that just costs some money. You know, it might cost you $50 a month to have a payroll provider. That's $600 a year. That kind of offsets some of those tax savings. So I'll pause there. Greg, jump in here. Looks like you've got a question.
Greg Dans, you're muted in case you're talking. Okay. Well, he's getting that figured out. Shane, when you're saying like to file your taxes as an S corporation, can anybody do that? Like, what happens if like I'm an LLC? I'm not, my business isn't structured as an S corporation right now. I'm an LLC. Can I still file as an S corp?
Yeah.
And what does that mean when you say file as this? Like, what do I need to tell my accountant something, or?
Yeah. So the rules are a little bit tricky, but to make it simple, the answer to your question is yes. So one thing, there's a distinction between your legal entity type versus your tax entity type. So basically, an LLC can make an election to be taxed as an S corp, but you don't have to create a whole new company. You don't need a new corporation that's formally a corporation for legal reasons. You can just take an LLC and it remains an LLC legally. When you sign contracts and when people do business with you, all they know is that you're an LLC. But then you can make an election to say privately to the IRS, I want to be taxed as an S corp. And that's actually what we recommend. So, you know, LLCs give you all the flexibility in the world. They're really easy to set up. That's how we recommend everybody start. If you don't already have an LLC for your business, you certainly should have one just for legal protection, legal liability. And then, yeah, we can take that LLC and turn it into an S corp for tax reasons. But again, we're not even really changing it. We're just changing how that existing entity is taxed. There is an election that you have to, a form that you have to file with the IRS. To do that, you're supposed to do that in the beginning of the year. So you can't really wait until tax time is what the IRS will say. In practice, that turns out to mostly not be true. If you kind of know what you're doing and the right legal language to insert, which, you know, we obviously do, then you can get late elections through. There's some limits on that, but, you know, generally speaking, anytime during the tax year that you want to switch to an S corp, you can normally make it happen.
And how many votes do you need to win the election? Like, do you need like, you know, like 10 votes, or, and what kind of campaign? No, I'm sorry. I'm totally kidding.
You know, you do actually bring up a good point, which is if you do have multiple owners, you do have to get consent from every owner in the business. And now in most cases,
right, that's what I was asking.
Yeah, I know.
Okay, Lance Odell, he probably actually has a good question.
What's up?
Yeah.
Hey, so I have a question. So let's say, you know, for some of us that are figuring this out, like, oh man, I paid a lot of taxes in previous years. I should have been filing as an S corp if I made over that certain amount. Do you advise or think it's advisable to like maybe amend a return, open it back up, and then, hey, now we're looking at we're an S corp, et cetera, and kind of like, what is that type of, would that be beneficial to some people that have been paying a lot in taxes, you think?
Yeah, fantastic question. However, you can't go back and change how you file. You can't go back and say, I filed as a C corp or I filed as a sole proprietor in the past, and just kidding, I meant to file as an S corp. That is not something you can do through the amendment process. So it is like a prospective election. you can draw a line in the sand basically at any point in time and say from here on out, I want to be treated as an S corp, and the IRS, generally speaking, will honor that. There are some, edge cases we could get into, which I'll just summarize to say, if you haven't filed the tax return yet at all, then there may be an opportunity even on back tax returns to basically make the election and file those back tax returns, as an S corp. But once you've filed a return, then you're not really going to be able to go back and change the entity type to file as an S corp in the past. So it's mostly a go forward prospective election, which is a shame, because there's a lot of accountants, a lot of CPAs out there that they don't even ever bring this up to their clients, even if they know about it or know how it works. They just they kind of view it as too late, because you're supposed to make that election in the beginning of the year. And so if you're just going to your tax guy at the end of the year, he's like, well, it's too late. I just got to file it the way that it is. And he doesn't even tell you that, hey, now's actually the time to make it for next year, to make that election for next year. You've got enough profit where it totally makes sense. Here's all the stuff that comes along with that. Here's the extra requirements, but also here's how much it's going to save you. They just don't have that conversation, because frankly, they're in the business of preparing tax returns, not really advising clients on how to save tax during the year. Okay.
And just to maybe dollarize the kinds of savings that you can get by doing this, Shane, would it be fair to, as an example, say, okay, if I'm paying myself $100,000 through, W-2 wages, right, that I'm paying at least $15,000 in payroll tax, right? Instead, I could pay myself $50,000 in wages, take the remaining $50,000 as a distribution, and that right there is saving me $6,000 in payroll tax, because would that be, or 4,500 or whatever it would be?
Yeah. Math is wrong, but conceptually that's right. So yeah, high level, easy way to think about this is basically you're going to pay 15% on all of the profits of your business. And then as a sole proprietor, which is kind of the default status. So we're talking about putting your business income on Schedule C of your 1040. That's normally how it goes, unless you do something special with an LLC. Now, if you have multiple owners in your business, then you'll generally be, the default treatment is to be treated as a partnership. And, this kind of dovetails nicely into where I was going to go next, which is just to very briefly touch on the other structures that are out there, and why I I skipped to the answer without kind of walking you through why the S corp is the best. But yeah, high level, that's right. You're going to pay 15% on everything. If you switch to an S corp, you pay yourself some quote unquote reasonable salary, and then you pay your 15% on that amount. But then whatever's left over after that, you dodge the 15% completely. So using Robert's example, like if I'm a sole proprietor, I'm making $100,000 in profit, I'm paying about $15,000 in self-employment tax. I switch to an S corp, I start paying myself $50,000 in wages. So I'm still paying that 15% on that first 50, but then I save the 15% on the other 50 that's left over after paying myself. So that's like, $7,500 in tax savings just by filing a form and sending it to the IRS. The trade-off is now you do have 2 tax returns to file instead of 1. So it's probably going to cost you an extra $1,000 at tax time to get that extra tax return filed. So that cuts into that $7,500 of savings. And then you might spend, $500 or $600 a year on a payroll provider if you're not already running payroll. So maybe we're talking, more $6,000 of net savings. But as the business grows, as your profits grow, those are fixed costs. Filing the tax return and paying for a payroll provider are fixed costs. So your savings just keep scaling with the profits of the business. So that's why we think like around 100K is a good number, because it's like you're basically getting paid, call it $500 a month for a little bit of extra overhead, maybe a little bit of extra headache. And that, but you're also laying the groundwork for the future so that if your profits grow, you continue to save more on taxes and remain efficient. The other thing that I didn't even mention is you create a separate tax entity and you kind of open the door for quite a few tax strategies that you just frankly can't do when you're a sole proprietor, because you and your business are one and the same. Once you have an S corp, you've got a separate tax entity, and you can basically do some deals with your business and take advantage of the tax code in sort of special ways. And that's what I kind of want to wrap with, is what some of those, more interesting tax things that can be done are. But just briefly to touch on the other structures, so there's a C corp. That has the famous double taxation. So regardless of how much money you make, you're going to be paying 36% in income taxes. That's the number one reason why we stay away from C corps. If we're doing a software startup where you're going to have lots of losses for a long time and invest a ton of money before it eventually becomes profitable years in the future, C corp could be a good option. But in most cases, for small businesses that are sort of profitable, C corp is really not great for that. Partnership is, again, the default treatment. It's super flexible. So if you've got to do something really complicated with your capital structure, like you've got multiple investors with different deals and different payouts, then partnership is probably where you're going to have to go. But for most simple, businesses where it's just, a handful of owners and they're all kind of got the same deal in terms of how their equity works, then, S corp works just fine for that. It's a little harder to dodge those self-employment taxes with the partnership. So that's, again, why we like the S corp. And then finally, we talked about the sole proprietorship, which is actually great. And that's where I recommend everybody start, is just like a single member LLC, tax as a sole proprietorship. And then once you get to that 100K of profit number, flip to an S corp and probably stay an S corp forever. The only caveat there would be if you get up into that top tax bracket, then sometimes there's a good case for switching to a C corp, because the top tax bracket is technically 37% and a C corp gets you down to 36, but it also has some other kind of side perks. So,
which that's where we're all headed. Top tax brackets, baby. Let's go.
Let's go. Okay. Final thing. So talking about these three moves I think everybody should make is, have a good accountant, have a good bookkeeper, and then structure your business right. So make that move to the S corp as soon as it makes sense. Don't wait any longer, but also don't do it too early. And then finally would be, once you're at that level, you've got 100K of income, you have started being taxed as an S corp, then really the next thing that you can do from a tax perspective is hire a tax advisor who's going to work with you consistently throughout the year, be proactive, and move the needle on your tax in sometimes pretty significant ways. And I'd like to draw this distinction between like a tax advisor and a tax preparer. Everybody knows what a tax preparer is. You show up at year end, you bring them your financials. They basically take the numbers from your financials, tweak them slightly, put them into some tax software, and then give you a huge bill for their, 45 minutes of glorified data entry. That's great. And that's honestly what I recommend people do when they're starting out, when they don't have much in the way of profit. If you don't have much profit, you're not going to have much tax, and a tax preparer is probably just fine. At some point, and maybe it's around that 100K mark, there's enough there that you can play with the tax rules a little bit. And there's things that you can do during the year. Now, when I say during the year, I mean before December 31st. So that's the other piece of this, is if you get to your tax preparer at the end of the year, it's too late. He can't even do any of these tax strategies because that's tax fraud. You can't pretend that things happen during the year that didn't actually happen. You have to report them as they happen. But if you're working with someone during the year, then you can kind of change the facts as they unfold, make better decisions, and take advantage of some of the tax code to drive the tax down. So I'm going to run through just very quickly a handful of the things that we do with our clients that you could bring to your existing CPA. If it is somebody that you work with during the year, ask them about it, see if it's a good fit. So the first one that I think, and I like to touch on this one first just because it doesn't work for everybody, but if it does work, it can be absolutely huge, which is paying your kids. And I use kids very loosely. It's really, if there's someone in your life that you are giving money to and does not have an income of their own. So this could be grandma, this could be your niece that babysits your kids on a regular basis. Anybody that's in a real low tax bracket or ideally, has really no other income is going to be potentially a good fit for this. Kids typically are the best because if you're their legal guardian, then you can pay them money, but basically keep the money for yourself. You don't have to actually give it to the child. You still remain, in control of the funds. But it can work with other situations as well. Grandma, in-laws living with you, something like that can often work quite well. And so the way this really works, it's almost all in the name, is just that you start paying your kids as employees of your company. And then you do need to make this legit. So they either need to work in the company if they're old enough to work in the company, and that's great. They may already be working in the company anyway for free.
Yeah.
The other option for young kids that we do is you can set them up with like a licensing agreement where you just use those super cute baby pictures in your marketing materials. That makes it legal to pay them. And now you've got a way to pay your kid, even though your kid is, 6 months old. So, generally speaking, I haven't found a case yet where we can't come up with a reasonable justification for paying a kid, sort of regardless of the situation. And, just to put some numbers to this, if you pay them up to the standard deduction amount, then, so that'd be $15,000 basically per kid, then they pay zero income tax on that $15,000, but you get the deduction for your business, which means you basically don't pay tax on it either. So you're sort of shifting $15,000 of income per kid from your tax bracket, which is probably 22, 24%, maybe even higher, to a zero tax bracket, because anything under the standard deduction amount isn't going to be taxed. Any questions on that? Does that kind of make sense high level?
I need to get busy having some more kids. I just saw in my mind how I can literally pay a net zero taxes if I have enough of them.
That's right.
As your income grows, you'll have to continue to produce more children, though.
It's a linear one-to-one relationship. You need one kid for every additional $15,000 of profit.
Exactly. Yeah.
I'll add that to the 5-year business plan.
That's so good. That's Aaron Shea with Albuquerque Construction, a great guy. Does that kid and paying kind of loved ones, family thing make sense to everybody? Did everybody get that? Because that took me a couple times to understand the first time.
One thing I will throw out there that sometimes people get wrong is it's called the pay your kids strategy. It's not the pay your spouse strategy. If you're paying your spouse, you're probably actually just wasting tax. You're creating more tax for yourself, because there are some employment taxes that come along with this. So even for your kids, you're going to pay that 15% of employment taxes on what you pay them. But as long as you're above the 15% mark in terms of your tax bracket, then it's a good trade, right? You're trading, say, 22, 24% of income tax for 15% of employment tax. But that doesn't really hold with your wife, because your wife, your spouse, is going to be in the same tax bracket with you. Your income is treated the same. You're going to file a joint tax return. So don't pay your wife really unless you absolutely have to, which you may have to if she's really a significant contributor in the business, just because that's how the rules are written. But you wouldn't want to pay her just as a tax strategy. That's a bad move.
Really good distinction.
Yeah.
Yeah, Fletcher, what's up, buddy?
First off, I have to pay my wife regardless if she goes to work or not. Second, about the kids and the 15% and making sure that I can't repeat what you said, but making sure that it's 20, 24%. How do you do that? How do you determine that that's happening?
Yeah, so we do tax estimates for our clients every quarter, and part of that estimate is figuring out what tax bracket it looks like you're going to end up in. But you could go to the IRS website. If you just Google this, you'll find it. Google US federal tax brackets or something like that. And, it'll list out, there's a good IRS page that I've visited, who knows, 100 or 1,000 times that lays out those tax brackets. And so kind of just figure out where your profit, where your total income falls in those brackets, and it'll have the percentage there. And then basically, as long as that percentage is over 15%, then paying your kids is probably a good strategy, and you'll pick up basically the difference between that marginal tax rate for your bracket and the 15% of employment tax that you got to pay when you pay them as employees. Does that make sense?
Yeah, if you said it slower, but I was that's why I need a tax person. But thank you. I get it. I understand tax brackets. I just now need to figure out to make sure that UI tax for hiring my children, which I already do, that I'm over my tax bracket. So
yeah, so there's the 15% of
the
15% of employment taxes is the federal tax. I normally kind of simplify and focus on that. There are often, some state or even local taxes that go along with payroll as well. So really, that number might be more like 16% instead of 15. That said, those state and local taxes on payroll tend to be quite low. So normally focusing on that 15% kind of benchmark is good enough. And also just the way the tax brackets are, it's normally not very close. You're either in the 22% bracket and it's worth it, or you're not.
Yeah.
But yes, I mean, you bring up a good point. Like, it varies by state, and there's a little bit of extra probably on top depending on your state.
Yeah. Thank you.
Yep. Okay. Robert, do you want to do one more of these kind of interesting tax strategies?
Yeah, let's. I mean, if I was gonna say, does anyone else have any pressing questions? But if there's no pressing questions, let's do one more.
Okay. Yeah, and jump in. I mean, stop me anytime. So this one, similar idea in some ways. We call this the Augusta rule, and this is a special rule in the tax code that basically says you can rent out your personal residence. Now, it does have to be your personal residence. You got to actually live there. A vacation home, interestingly, can qualify as well. But you can't do this with a rental property. So any property that's rented more than 2 weeks out of the year would not qualify. That's why, and it also has to be your personal residence. So, if you've got two homes and you Airbnb one while you live in the other for half the year and go back and forth, that this isn't really going to work. But for most people, that don't have a second home and they live in their home year round and they don't rent it out on Airbnb or anything, this works quite well. And so basically the way that it works is the IRS says you don't have to even report any rental income as long as the period of rental is less than 2 weeks in the whole year in total. There's no requirement that it has to be a consecutive 2 weeks. So you could, break this up to 1 week, at one point in the year, another week later. But basically you get 2 weeks for free, tax-free, of rental income on your personal residence. And so the way we make this work, so this is a good example of one that will not work if you're a sole proprietor, because you have to have a separate tax entity. But it does work if you've got the S corp. So basically the way this works is we have your S corp rent your home from you, the individual, which means that the S corp gets to deduct that as additional rent expense. So these are not going to be huge numbers, but depending on the size of your home, your home might rent for, I don't know, $5,000 or something like that for 2 weeks on, Airbnb, which is where we, probably go to get a comparable rental for the price. So you'll rent your home to your S corporation. Your S corporation then takes the deduction, but because of this special rule, when it pays you, the person that it's renting from, you don't have to pick that up at the personal level as rental income because of the special Augusta rule. So you essentially just get to take cash out of your business and pay no tax on that cash personally, And even better, you get to count it as an expense for your business for tax purposes. So it makes it look like your business made less money.
So just to let everyone know, because one of the things I like about Shane, working with Shane, is he kind of just tells me the new tax saving strategies. And I just kind of follow his lead. You know, I'm like, great, that sounds great. But we actually use this Augusta rule. And what we literally did to maybe bring it into like, hey, how does this specifically work out? Is we found like the average nightly rate of what the home I was living in at the time was going for on Airbnb, right? So we found other homes in the area, kind of created an average price. We mapped that out over the course of 14 nights. So how much would it be for 2 weeks? And basically that was all tax-free cash, right? That I was able to keep. My dad's done it as well. Tim Redmond, he's done it as well. And so that's how that rule actually works. And it's kind of a weird rule, but how this rule was formed is so wild. Shane, can you just real quickly tell the story?
Yeah.
Like just 30 seconds, a minute of how this rule was formed?
Yeah. So Augusta comes from Augusta, Georgia, where they hold the golf Masters tournament every year. I'm not a golfer, so if I got that wrong,
dude, you're doing great.
All right,
doing great. You're right. Yeah, that's good.
But it's essentially the story goes that some people in Augusta, Georgia, were frustrated with all of the like rich people coming in for the Masters every year, overrunning their town and them getting absolutely, nothing from it or for it. And so some of them must have been rich themselves, or at least known people in high places or something, because they got this rule put on that basically says, they can rent their home out for 2 weeks during the Masters every year, and they don't even have to pay any tax on it. So that's where it comes from. The good news is, it's not state specific; it's at the federal level. So we all now get to take advantage of it. I think it was a very little known rule for a long time that most people are like, well, I don't want to rent out my home, and there wasn't even a way to do that until Airbnb, but for tax, strategy, it really works if you've got a separate company that's its own tax entity.
Awesome. Shane, do you have a few more minutes to answer questions?
Yeah, for sure.
So it's 10 o'clock. If anyone needs to bounce, feel free to bounce. But we're going to be here answering questions. And if anyone was in the workshop yesterday, and you want to ask any questions about what we covered yesterday as well, this is the time that we're doing that too. When I ended the workshop, I told everyone, hey, we're going to dedicate, because we didn't really end with a lot of question and answer time. I said, we're going to end by after the group call tomorrow, hop on for your questions regarding the workshop yesterday. So we've got a few questions for Shane. If you got other questions related to the workshop, we'll address those in a minute. But Scott Whitwam.
Just real quick on that Augusta rule, Shane. If I had 2 different S corps, can I do that twice in a year on my personal residence, or is it excluded to only one time a year to one S corp?
Yeah, it's not really even about the S corps. It's really about you personally. You only get 2 weeks a year for free personally, which is what makes all this work. So, the short answer is you can only do it once. I guess the exception to that, or kind of the opposite of that, would be if you had a single S corp with 2 owners in the business. Each owner could do it for themselves, and the S corp could pay each owner to rent their residence. So you can do it multiple times, but you can only do it once per an individual, if that makes sense.
Yep, perfect. Thanks.
That's great. Great question, Scott. Brian Howard.
Yes, I kind of tie into that answer you just gave right now. If I have a partnership and we both have our personal residences, can we each do 2 weeks?
Yes.
And we just count it as rental income? We don't categorize it any other way?
Well, it's rent expense for your business. So
Well, that's what I mean.
yeah. Rent expense for your business, but then on your personal tax return, the great thing is you don't even have to report it. So it's not like you fill out some special form or you really have to work with your tax preparer to make sure they do it right. They don't have to do anything at all other than you don't even have to tell them about it. So it just shows up on your business financials as additional rent expense, which means, whoever's doing your tax return will just take the rent expense number and put it on the tax return as rent expense. They don't even really have to know about it. And as long as it's in the financials, and then there's nothing to do at the personal level. So it's pretty easy, to make it legit. In case you got audited, I would recommend putting together just a real simple, 1 paragraph agreement. And then, the other piece is there does have to be a real business use here, business reason here. So you've got to actually use the home for the business in some way. You can't just say that you did. But normally it's not too hard to come up with some reasons why the business needed to use your home. So, it could be that you threw a employee party. It could be that you had some people in from out of town and you let them stay with you. It could be not even, employees of the business. It could just be your parents or your in-law or your uncle, that is a sort of trusted business advisor that came to stay with you. If you guys talk business, which I've never met a business owner that can stop talking about business with everybody. So you probably talked a bunch of business while that person was in town. If they were there for 3 days, well, there's 3 of your 14 days. Just jot down some notes about that so that you've got it in case you get audited. But that's
You
really
recommend breaking the days up or doing them all at once, or does it matter?
Doesn't matter. Yeah, it doesn't matter as long as and you don't have to do all 14. If you realize, shoot, I had people staying at the house, that were working with me or whatever for 10 days this year instead of 14. That's fine. Anything under 14 will work.
Thank you.
Yep.
I would recommend doing 14, and Shane is giving you like the proper like kind of tax advice if like worst case scenario happened and you're audited by the IRS. But I would just encourage everyone here as a non-official tax advisor to do the 14. And if you want some sort of documentation of it, then document how you needed to use your house for at least 14 days a year for business related stuff, right? Oh, I was, needed my house to plan my day every day for 14 days. That would work. You don't have to schedule a family to come visit just to get this tax advantage. So, all right.
There have been some cases, just to make sure everybody, I don't want to set people up for failure in an audit, but there have been some cases where this Augusta rule deduction has been basically denied by the IRS. And typically it does revolve around this like business use thing. So, having a meeting with 2 people in a 4-bedroom house would not be a good reason to rent out the whole house, right? The IRS would say, no, you should have just rented some office nearby instead for, $500 a day instead of $1,500 a day or something like that. And so that's why I say, try and come up with a reason why you really need to use the whole house. But there's easy ways to do that too. Like, well, all the partners had to get together. All the partners had kids. We wanted the wives there and we just needed a big space. Okay, well, that's totally, legit. But if it's just 2 people having a meeting in a giant house, that's probably not quite good enough. But
Anthony, San Felice, back to you, buddy.
Yeah. A couple
Chris.
questions. Can you hear me?
yes, sir.
Yep.
Can you hear me? Oh, okay. Sorry, I just put my headset in. Is this exclusive to home ownership, part A, and then part B is actually I forgot part B. I'm looking at a
Well,
cop
let's
right
go with
now.
part
I don't
A
want you
then.
to see me on the phone.
No. It doesn't have to be, you don't have to own the home. You can be renting, and then you can basically do this as essentially like you're subletting that space to your S Corp. The requirement is just as your primary residence. Yeah.
I actually remember the second part. How does this tie in with writing off use of home as a home office?
Yeah, you can do both. They don't really affect each other. you really shouldn't be like double dipping. So in theory, what you would want to do is exclude the 2 weeks that your business rented the home completely from your like home office, calculations where you come up with your square footage and then figure out how much you used for your office or whatever. That's stuff that I would recommend you work with your accountant, CPA, tax advisor to make sure you get right. But you can do both. You can certainly use, both strategies. Just ideally shouldn't be, or, technically shouldn't be double dipping. You shouldn't be counting the same 2 weeks should not count. You shouldn't take a percentage of your utility costs during those 2 weeks when you were already renting out the home completely to the business.
Awesome. Chris, did you have a question, buddy? Chris Everett?
He asked the same thing I was going to ask.
I saw your son in the background while he was talking about the paying the kids rule.
Yeah.
He left, and so I don't know. Oh, there he is. Did you hear that? Daddy just got you a job.
Yep. Time to go to work. You're not going to summer camp today. You're working with Dad.
Yeah. And he's gonna keep all the money for you because that's how it works.
He knows finances. He knows how to save, give, and spend. So
yeah. My parents really tried instilling all those things in me as well. Like my dad would pay us to read books. I could pay us, $1 for every like legitimate book I'd read, but I'd make the money and then I'd spend it all immediately. He would be like, now you can buy one G.I. Joe. I remember literally being in Toys R Us as an 8-year-old. You can buy one G.I. Joe and you'll still have $40 left. Or you can buy 3 and you'll have nothing. And I go, I'm buying 3. I bought 3. And now we're in business together, which the kind of sales, my background and his background as a CPA accountant, it balances things out really well. So anyway, all right. Any other questions? This has been great.
Looks like Anthony maybe has a hand raised.
I thought he may have left it up.
Okay.
Yeah.
All right, cool.
Yeah, sorry about that.
You're good. Okay. Well, Philip. Yes, dude. Philip is based in Denver, Shane. I actually think
awesome.
He's a really good snowboarder too. I actually think you could be friends with this guy. He's a cool dude. Yeah.
Thanks, Robert.
Yeah.
Shane, yeah, man, I've actually been thinking about changing my CPA. So just wanted to ping you and say, let's talk.
Yeah.
Sweet.
So yeah, I actually was gonna get into that. So at the end of the day, what we really care about, Redmond Growth, is that you guys aren't paying more than you have to the IRS or to your state tax commission, while also not doing anything that's going to get anyone in trouble, right? That's what we care about at the end of the day. If you've got a great CPA that's already doing a great job of that, and that CPA is already knocking out all these things that we went over for you, keep them, right? But I do recommend Shane. He is the guy that we kind of at Redmond Growth refer people to whenever they need someone for tax and bookkeeping, which I'd recommend having him to do both. He does it for me. He does it for my construction company. He does it for a number of other clients. And I just rest with such peace of mind. I mean, even this week, right? I got on, I told Shane, I was like, dude, I've always paid my taxes at the end of the year in one lump sum. I like doing that because I like keeping cash, but I know that there's some penalties if I don't do quarterly. So let me do the quarterly this year. And I had no idea. Like I was completely lost into like how to make a quarterly tax payment. And one of the CPAs got on a call with me and literally handheld me through the entire process. Like that's the kind of difference that they made. Like I let her know the day before I need some help, and the next day we had a call scheduled and she was walking me through. And I just had never found that with any other CPA, right? I never found someone who was proactive, who's talking to me throughout the year about tax strategy. And so yeah, I recommend Shane But at the end of the day, we just want to make sure that you're prepared for tax season, not paying more than you have to, while also not doing anything that's going to get you in trouble. I think one of the biggest values of Shane is if you're not getting updated financial reports on a monthly business, it's like you're flying blind a little bit. You know, it's like you don't have the dashboard of controls in the cockpit that tell you what direction you're heading in and where you're losing money. And that's one of the main reasons why, is because a lot of people don't do that. A lot of people give you quarterly reports, or you give them all your financials at the end of the year and they just go, oh, I'll take care of it. And then you end up paying a lot more than you have to in taxes without even realizing it. So in terms of how much does it cost to work with Shane, this is another reason why I love working with him, is a lot of it depends on what you actually need in your business from him, right? If you just want him to do your tax work, if you want him to do your tax and bookkeeping, if you want him to do your tax and payroll or no bookkeeping, or do all three in payroll, if you want him to provide more higher level, like CFO type of advisory services, there's a lot of different ways that you can work with Shane. What we typically see is most people end up paying Shane $600,000 a month, somewhere in there, depending upon your situation. So we've had a few people talk about how they're interested in connecting with Shane further. We would love to facilitate that, but Shane has actually a special offer that him and I came up with just for Redmond Growth clients. Okay, we're calling it the slow season special, right? It's the slow season special. So Shane wrapped up his tax year in April. That April kind of extends into May with all the work that they're having to do. But in June, it's like the best time to be talking to a CPA because it's Shane's slow season. And literally, there was a point where towards like the end of this year, even before the end of last year, before the year even ended last year, where Shane was like, dude, I cannot take any more clients. I'm swamped. Right. So that's a real thing that happens. And this is this is not a, high pressure kind of tactic. This is truly the best time to be talking to Shane if you're interested in talking to someone else, if you want to learn more, which is why we're giving you the slow season special. So Shane, tell them what the slow season special is.
Yeah. So, basically what we put together is 0 onboarding fees for you guys, so you won't pay anything. We do everything on a flat monthly fee basis, so we don't bill hourly or anything like that anyway. We're going to give you $100 off your first month, but really the main thing is, so I've got a team, that works for me, and we'll hook you up with somebody that's really good and, well trained and knows their stuff. And really a small team. You'll have a tax director, we call it, a tax advisor. These are both CPAs. And then if you want our accounting service, then you'll have kind of a bookkeeper in the background that will be sort of invisible to you. So you just have one person to deal with. But I am normally not, no longer involved in all of the day-to-day stuff. And so what I wanted to give you guys is, something that really is like near and dear to my heart, because I grew up poor and I've worked very hard to save and invest my money, and have just really learned the financial planning part of things. And so I want to give you guys like a real detailed financial plan for like the next 2 years. Look at your situation in detail. So like what we're talking about is like an hour call at least. We'll probably book it for 90 minutes. So we got plenty of time to walk through your financial situation. It'll be with me personally. And then after I like really understand your financial situation. So I'm talking about like, how much debt do you have? What do you have in assets? What do you have in savings? What are you saving right now? Do you have an IRA? Do you have a 401k? Do you have any of these vehicles that are tax efficient for savings? So more on the financial planning side. This is not something that you can find like on our website. It's not like a service that we offer. It's just going to be me doing this personally, only for these Redmond Growth clients. So we'll give you that, as part of your sign up. We'll get you onboarded and kind of set up so that I understand your financial situation. Then we'll schedule this kind of special extra call. And then I'll come back with a real full like deliverable for you so that you've got like very concrete steps in order tailored to your situation for like, here's the things that you need to do to get out of debt, or here are the things that you need to do to really increase your savings, and here's how to do it in a tax efficient way. Here's the investments that you need to make, etc. So, that's the offer. Definitely not something that I've ever done, frankly, for any other clients, because 90 minutes of my time is pretty valuable at this point. But I think that this is something that I kind of want to start offering as a firm in the future. But unfortunately, like right now, I'm really the only person in the firm that really knows the finance stuff well enough that I feel comfortable to do it. So yeah, that's the offer. The only caveat is you got to sign up with us by July 31st. So you got about a month to think about it, book a meeting with me if you need to. The other cool thing is you can actually just sign up directly with your Renman Growth coach. So if you want to get things rolling right away, you're like convinced that we've got a good program here, you can actually sign up directly with them to make it easy. And then that'll kick things off on our side. We'll get your, first onboarding call scheduled. We'll reach out, get your prior year tax returns, all that good stuff to get things rolling. And yeah, I mean, what Robert said is true. This really is like slow season for us. And so it's the best time for us to bring on new clients. You'll get, a lot of our time and attention right now during the off season and get everything really in good shape. It also is, we've only got 6 months left in the year to do these more advanced tax strategies that have to be done during the year. Right. So it's time to sign up for you as well, because if you wait until tax time, then we really become, for 2025, we're preparers like everybody else. We can't touch 25 if you don't come to us until after the year is over. And it takes time to do some of this stuff. If you're going to pay your kids, you got to set up bank accounts for them, get them on payroll, so we can't do it all in December. Now is, truly a good time to sign up, and we could probably save you quite a bit of tax.
That's awesome. Yeah. So this lasts until really the a little bit over a month, like 5 weeks here. After the end of July, it's just not something Shane can offer anymore, because this isn't like Shane is like throwing your finances in Chat GPT and asking it to create a plan and then meeting with you about the plan. This is him literally going through it with his expertise and knowledge and personal financial planning, which is just not something that you'll find many CPAs do in general, which is huge. As honestly, Shane, that you were talking about that, I was like, I think I actually want to do this with him. So anyway, so yeah, if you would like to sign up, Shane, let's do this. Let's put a link to your core packages on your website. These core packages, you can kind of see the general price points. Again, that price may change depending upon how big of a business you are, how much you want Shane doing. Is he managing payroll? What all is he doing for you? That price could change, but the price points here will probably work for most everyone. They've worked with everyone except we've had one client that's paying Shane a little bit more because Shane's managing a lot more for that client. But they're still not paying more than $1,000 a month. So if you'd like to just get the ball rolling, you can sign up using this link here. Otherwise, you can just talk to your coach, and your coach can get you signed up, or even if you need to meet with Shane one-on-one before signing up, we can do that too if we need. But we really got everything that we need to get you signed up and get you rolling so that we can schedule this financial plan, take advantage of a discounted fee a little bit, but more importantly, have the peace of mind that you are simply not paying more than you have to. That's the thing I love about Shane, is that I'm not the one coming to him, telling him about, hey, have you heard about this new tax saving strategy? Or, hey, have you heard about this S-Corp thing? Are you electing me as an S-Corp? He's telling me what I need to do. Right. And typically with CPAs, I've worked with a lot of CPAs, it's the other way around. So Shane, thank you so much for being here, man. Really appreciate it.
This was
fun. This is a great time. Appreciate all the questions. Yeah, if there's anything else, everyone have a great rest of the weekend.